Welcome to Financial Market Insights for Traders. I'm your host, Sophia. If you're new to investing, figuring out how to pick the right stocks can feel like learning a foreign language. Many beginners focus solely on company news or financial statements, but there's another powerful approach you shouldn't overlook: technical analysis. Technical analysis, or TA, is a tool used by traders and investors to evaluate stocks based on their price movements and trading volume, not just earnings or news headlines. If you've ever asked how to analyze stocks for beginners or wanted a shortcut to better timing your trades, TA is where you start. In this episode, we'll cover chart patterns, trends, and key indicators that help you read stock charts like a pro. We'll also share tips to avoid rookie mistakes and link you to beginner-friendly platforms to get hands-on. What is technical analysis? At its core, technical analysis studies how the price of a stock moves. It assumes all known information, earnings, macro data, sentiment, etc., is already factored into the stock's price. What matters most is how the market is reacting, and price charts are the best reflection of that behavior. Rather than asking, is this a good company? Like fundamental analysis does, technical analysis asks, what is the price telling us about investor behavior? This makes it particularly useful for traders or investors looking to spot entry and exit points, identify momentum or trend reversals, time short to medium-term trades, add structure to stock picking strategies. You don't need to be a mathematician or finance pro to use it. You just need to recognize patterns, apply a few rules, and keep your emotions in check. Why should beginners learn technical analysis? Here's why TA is worth learning early in your investing journey. Better timing. Technical analysis doesn't just help you know what to buy. It helps you know when to buy or sell. Simple visualization. A quick glance at a chart can tell you whether a stock is in an uptrend, downtrend, or going nowhere. Works across assets. Whether you're trading stocks, ETFs, crypto, or Forex, TA principles stay consistent. Pairs well with fundamental analysis. Many successful investors combine both strategies for better decision making. If you're building a dividend investing strategy or comparing value investing versus growth investing, TA can help you enter at better prices and manage risk more effectively. Understanding price charts. Before we get into patterns or indicators, it's important to know how to read a basic stock chart. Here are some key elements. Time frame. This is the horizontal x-axis. You can analyze daily, weekly, hourly, or even minute-by-minute charts. Price. This is the vertical y-axis showing the price levels. Candlesticks. Each candle shows the open, high, low, and close for the time period. Volume, usually shown as bars below the chart, indicating how many shares were traded. Start by analyzing daily charts. They strike a good balance for beginner traders. Common chart patterns and what they mean. Chart patterns represent market psychology. They occur because human behavior, fear, greed, panic, optimism, tends to repeat. Head and shoulders, tight reversal. Morningstar, +1. Stocks for beginners, +1. Visual, a tall peak. Head, between two shorter peaks, shoulders. Signal, a trend is likely ending. A bearish head and shoulders signals a drop, while the inverse version signals a rise. Double top/double bottom. Tight reversal. Double top, price hits the same high twice, fails to break through, signals possible decline. Double bottom, price hits the same low twice, holds support, signals a potential rally. Flags and pennants. Tight continuation. Flag, small rectangle or wedge that forms after a strong move up or down. Pennant, a triangle-shaped consolidation after a big price movement. Signal, price usually breaks out in the same direction as the previous move. Chart patterns should be confirmed with volume. A breakout with strong volume is more trustworthy than one on weak volume. Spotting trends and drawing trend lines. One of the first things to learn in technical analysis is how to identify a trend. Uptrend, price forms higher highs and higher lows, indicates buyers are in control. Downtrend, Price forms lower highs and lower lows. Suggest selling pressure dominates. Sideways/consolidation. Price moves within a horizontal range. Neither buyers nor sellers are in control. Drawing trend lines. Use a trend line to connect two or more swing lows in an uptrend or swing highs in a downtrend. If price stays above or below the line, the trend remains intact. A break of the trend line often signals a shift. You can practice trend lines using real-time tools and beginner charts at crystalballmarkets.com, a great resource for building technical analysis skills step by step. Key technical indicators. Indicators are math-based tools that help interpret price data. While they shouldn't be used in isolation, they're useful for confirmation. Moving averages, MA. Purpose. Smooths price action to show trend direction. Types. Simple moving average, SMA. Exponential moving average, EMA. How to use. A stock trading above its 50-day and 200-day MA is often in an uptrend. Relative Strength Index, RSI. Purpose. Measures momentum and identifies overbought or oversold conditions. Scale. 0 to 100. Tip. RSI greater than 70 equals overbought, price may fall. RSI less than 30 equals oversold, price may rise. MACD, moving average convergence divergence. Purpose, identifies trend changes and momentum shifts. Key signal, MACD line crossing above the signal line equals potential by signal. Avoid using too many indicators. Start with one trend indicator and one momentum indicator. Sample technical analysis strategy for beginners. Here's how you might combine what you've learned into a simple trading approach. Trend check. Is the stock above the 50-day MA and forming higher highs? Pattern spotting. Look for continuation patterns like flags or a breakout setup. RSI confirmation. Is RSI in a neutral zone, 40 to 60, suggesting room to move? Entry point. Buy on breakout from pattern with above average volume. Stop loss. Set just below the most recent support level. Profit target. Use previous resistance or a 2 to 1 risk-reward ratio. Technical analysis versus fundamental analysis. Some investors pit technical and fundamental analysis against each other. In reality, they're most powerful when used together. Fundamental analysis tells you what to buy based on company value, earnings, industry trends. Technical analysis tells you when to buy based on market behavior and timing. A good resource to explore both sides of this coin is the Crystal Ball Markets podcast. It's an excellent way for beginners to learn how to blend both strategies in real-world scenarios. Common mistakes to avoid. Overtrading. Don't trade just because you think something might happen. Wait for setups and confirmations. Ignoring risk. Use stop-loss orders. No trade should risk more than 1 to 2% of your capital. Overloading your chart. Too many indicators lead to confusion. Keep your analysis clean and simple. Trading against the trend. Avoid trying to catch tops and bottoms. Go with the flow. No trading plan. Every trade should have a reason, a risk level, and a clear exit. Final thoughts. Learning technical analysis can seem overwhelming at first. All the lines, candles, indicators, and jargon. But with time, practice, and a structured approach, it becomes a second language. And more than that, it becomes a framework for making disciplined, objective decisions, something every investor, beginner or pro, needs. Remember, technical analysis isn't about predicting the future with certainty. It's about understanding probability, risk, and market behavior. It gives you a visual and data-driven way to assess when to act and when to stay on the sidelines. Used correctly, it won't guarantee success on every trade, but it will help you develop consistency and control, two of the most underrated traits in any trading journey. And as you sharpen these skills, keep in mind that charts only tell one side of the story. A great trader learns to blend technicals with market context, sound risk management, and emotional discipline. That's how you move from being reactive to being strategic. So whether you're analyzing the SP 500, Bitcoin, or a small cap stock that just IPO'd, the principles of technical analysis stay the same. Understand the trend, respect the levels, manage your risk, and trust your process. If you're ready to put what you've learned into practice, start with a demo account. Draw trend lines, spot patterns, test your strategies, and most importantly, review your results. Platforms like crystalballmarkets.com offer easy to use tools and educational resources specifically designed for beginner traders. And if you're hungry for more insights and real world examples, tune into the Financial Market Insights for Traders podcast. We break down technical and fundamental strategies in plain English so you can keep learning on the go. Thanks for joining me today. I'm Sophia, and this has been another episode of Financial Market Insights for Traders. Trade smart, stay disciplined, and remember, it's not about being right every time. It's about being consistent over time. Until next time.